Welcome back to The Deep Dive. Today we are going straight into the source materials for a look at Indoco Remedies Ltd.
And this one is critical.
It really is. I mean,
Yeah.
this isn't just another pharma company. We're looking at what could be a massive turnaround story in progress.
They've been absolutely battered,
Yeah.
by regulatory issues, heavy spending cycles,
Yeah.
leading to some pretty significant losses.
So our mission today is to really dissect their Q1 and Q2 performance and figure out, is the company finally stabilizing? Does this recovery story actually hold water?
And that's a high-stakes question. For anyone looking at the pharma sector, Indoco is just a fascinating case study. You have to separate the operational noise from, well, real structural improvement.
Mm-hmm.
When a company is coming out of deep losses like this, the sequential performance, Q1 to Q2, that's what matters more than the year-on-year stuff.
Right. You need to see that immediate progress.
Exactly. We need to see clear evidence that their core engine, the one they invested so heavily in, is finally delivering profit, not just revenue.
Well, if you find this kind of evidence-based analysis crucial for your own research or your portfolio, please take a moment to support the show. Like this deep dive, share it with your networks, and definitely subscribe.
And don't forget that bell icon. That way you get updates on all our future deep dives right away.
Okay, let's unpack the foundation. For anyone new to the company, what is the architecture of Indoco Remedies' business engine? What do they actually do?
So, at its core, Indoco is a Mumbai-based pharma company. And they really focus on two main areas, manufacturing and marketing, what are called finished dosage forms, or FDFs.
The actual pills.
The actual pills, exactly. And also the active pharmaceutical ingredients, the APIs that go into them. And historically, they are very reliant on the domestic Indian market.
And what does that revenue split look like right now?
In the first half of the year, domestic formulations were the biggest piece of the pie, about 53% of total revenue.
Okay.
International formulations were next at 36%, with APIs around 10%, and then just a tiny 1% from other services.
So that 53% domestic reliance, that gives them a solid base, but it also exposes them to the ups and downs of the Indian market, right?
Absolutely. The seasonality, the intense competition, it's something you have to keep in the back of your mind when we get to the profitability numbers.
So in such a competitive sector, what's their advantage? What's the moat that stops a rival from just coming in and copying them?
The moat is all about compliance, scale, and reputation. Indoco has 11 manufacturing facilities.
11.
7 for FDF, 4 for API. But the crucial point isn't just the number, it's the regulatory hurdles they've cleared. They have approvals from the USFDA, the UK MHRA, TGA Australia.
All the big ones.
All the big ones. And achieving, and more importantly, maintaining that level of global compliance is just a massive capital and regulatory challenge. It's a huge barrier to entry for anyone else.
Provided they keep those clearances.
That is the key caveat. And domestically, they're very well entrenched. Their overall market share is 31st, which is okay. But their prescription ranking, which is a much better indicator of doctor trust, that's 20th.
That's strong.
It is. When you have brands like Cyclopam and Oxapod and over 45 products that are in the top 5 of their little niche, you've built brand equity that is very hard to disrupt.
Okay, so we've established the business. Let's get to the financials, because this is where the story gets, well, volatile. Before we look at the recent recovery, let's just frame the key metrics for everyone.
Right. When we're looking at a company like this, we focus on operational health. So first, we look at EBITDA. That's earnings before interest, tax, depreciation, and amortization. It's the true profit from their core manufacturing engine.
Strips out all the financing noise.
Exactly. Then we look at PTAT, or profit after tax. That's the final bottom line. It's what shareholders actually get.
And looking at the standalone trend over the last few years, it really shows the cost of their investments and those regulatory headaches.
The decline was steep. Really concerning. In FY23, they were running smoothly. An EBITDA margin of 17.4%, PAT margin of 8.6%.
Healthy.
Very. That fell in FY24, and then FY25 was the crash. The EBITDA margin just plummeted to 8.6%, and that dragged the company into a negative PAT margin, negative 0.6%.
And that's where the story pivots. Let's look at the sequential results from Q1 to Q2 of this year. This is what the whole recovery idea hinges on.
This is it, and the numbers are quite striking. Operational revenue grew 10% quarter on quarter, hitting about $4,718 million in Q2.
Okay, good top-line growth.
But the number that really matters is the margin recovery. The consolidated EBITDA margin. It jumped from that deeply concerning 4.1% in Q1 all the way up to 9.1% in Q2.
Wow, so that's more than double.
It's a massive 146% sequential growth in their operational profit.
Hold on, 146% is huge. But a 9.1% EBITDA margin, that still seems pretty weak compared to the 17% they used to do, right? Is this just a dead cat bounce, or is this that master manufacturing plan, the MMP, finally kicking in?
That is the billion-dollar question, isn't it?
Yeah.
And the jump is real evidence that the MMP spending is finally leveraging their fixed costs.
Okay, explain that.
They invested a ton in new capacity. That's a fixed cost. Now that the capacity is finally being used, especially in their international business, every new dollar of revenue drops much more efficiently to that EBITDA line.
That's operational leverage.
That's it in action. They're moving from just absorbing costs to actually utilizing their assets. And that efficiency gain is why the consolidated net loss narrowed so dramatically.
Yeah.
It went from a disastrous $363 million loss in Q1 to just $92 million in Q2.
But the sources also pointed to these elevated other expenses, right? They're still hovering around 160 crores a quarter. If operations are getting better, why are those costs still so high?
That's the poison pill in the P&L right now. Management says it's two things. First, they're still paying about 4 crores a quarter in USFDA remediation costs for that Goa plant.
The cost of fixing the problem.
The direct cost. Second, they're spending heavily on advertising and promotion for their new Warren OTC subsidiary to really build that brand. Once those two things normalize, those expenses should drop, which would give another big bump to their final profit.
So turning that engine around takes a lot of fuel. And for a company that invested this heavily, we have to ask, did they pay for this Q2 recovery with a mountain of new debt? Let's look at the balance sheet.
Right. First thing we look at is debt loading. The net debt to equity ratio was 0.68 in the first half.
Which is manageable.
It's getting up there. Total debt is substantial, around 950 crores, split between short-term and long-term. And that's the direct result of that CapEx cycle you mentioned. It's the money they borrowed to build out all that new capacity.
And that debt has been expensive, hasn't it? The finance costs have spiked.
Toxic, actually.
Hmm.
Finance costs are up 58% year on year. And this is a huge problem because it's a non-operational cost that just eats away at the profit they're fighting so hard to generate.
So it's a combination of more debt and probably higher interest rates.
Exactly, plus some foreign exchange losses. It's one of the key things stopping those EBITDA gains from turning into a consistent net profit.
Okay, so we have the operational improvement, the EBITDA jump, but we also have this drag from finance costs. Is the operational side turning into actual tangible cash in the bank? How's the operating cash flow?
And this might be the most compelling positive signal in the whole analysis.
Really?
Management pointed out that in Q2 alone, they generated almost as much cash from operations as they did in the entire last financial year.
Wow.
That says so much about their efficiency. And look at working capital management. Their working capital days, basically how long it takes to turn inventory into cash, it dropped from 82 days down to just 39.
So they've more than halved the time it takes to get paid. That's like changing the tires on a race car while it's still moving. That shows a real focus for management.
It absolutely does. It shows better inventory control, better debtor management, and that's vital if you want to service all that debt. And on that, they do have a plan. They're looking to repay 52 crores in the second half of this year and another 140 crores next year.
So sustaining that strong cash generation is everything.
It's paramount to hitting those targets.
Let's talk efficiency. The ultimate report card for any management team is how well they use their capital. So we have to look at ROE and ROCE. Can you just quickly frame those for us again?
Of course. We look at ROE, return on equity. That tells us how much profit they're generating for every single rupee the shareholders have put in.
Okay.
And then ROCE, return on capital employed. That measures the profit they generate from all the money they use, shareholders' money, plus any borrowed money.
And right now, those metrics are flashing deep red.
Oh, they are deeply negative because of the recent losses. The trailing numbers show ROCE at negative 0.49% and ROE at negative 7.02%. Even the 3-year average ROE is a pretty low 5.12%.
And what was it at its peak?
To give you some context, ROCE was at a very healthy 17% in FY23. Then it just fell off a cliff into negative territory.
So that dramatic drop isn't a fundamental flaw in the business itself. It's a direct result of that collision between the investment cycle and the regulatory problems.
That's exactly it. They spent all this money on the master manufacturing plan, building out capacity. But then the regulatory issues, especially that USFDA warning letter for Goa Plant 2, stopped them from actually using that capacity to sell their high-margin products.
So you have assets just sitting there depreciating while the debt is racking up interest.
and not generating nearly enough revenue to cover it all.
So what's the path back? What needs to happen for those ratios to get back to that healthy 17% level?
It is entirely 100% dependent on full utilization.
Yeah.
They have to use the new capacity from the MMP, and critically, they have to resolve those U.S. regulatory issues. Unlocking that high-margin U.S. revenue stream is the single biggest lever they can pull to drive those efficiency ratios back up.
This next segment is vital, then, for the future outlook. Let's start with the biggest, most persistent risk that keeps coming up in the source materials.
That is, without a doubt, the USFDA warning letter on Goa Plant 2, their sterile facility.
Why is that the #1 risk?
Because it just completely constrains their high-margin U.S. business. That business generated 285 crores in revenue back in FY24. That's a huge revenue stream that's been choked off.
Is there any sign of progress on that front?
Yes, some mixed signals. On the plus side, they recently got a positive EU GMP certificate for that same facility from the European authorities,
Okay, so Europe says it's fine.
which is a good sign. It validates their repair efforts. But the USFDA inspection is still pending. Management says they're ready. They've got an acknowledgement from the FDA, and they're hoping for that audit sometime this calendar year. The timeline for that clearance really defines the speed of the whole recovery.
And we saw a smart adaptation related to this risk. They're backing away from building a new sterile plant, right?
A very crucial de-risking move. They were planning a huge 200 crore capex for a new Generation 2 facility. Now they're rethinking that, leaning towards outsourcing to a CMO instead.
A contract manufacturing organization.
That's right. It immediately lowers their capital risk and frees up cash flow. It's a smart pivot.
Okay, so that's the big risk. On the positive side, where are the main growth drivers coming from?
The first is that MMP-driven efficiency. The plan is now fully rolled out, and it's already working. We saw that in the 21% year-on-year growth in international formulations revenue in Q2. They're expecting sustained double-digit growth from Europe and the UK from here.
Okay, what's #2?
Number 2, domestic and emerging markets. They're firing on all cylinders. Emerging markets revenue shot up to $618 million in Q2. That's up from under $400 million a year ago. That's driven by brand building in places like French West Africa and Latin America.
And the third driver?
The third is their strategic investment in OTC, the over-the-counter business. Warren Remedies is expanding fast. We're talking over 40% year-on-year sales growth.
But it's still losing money overall.
The subsidiary as a whole is due to the investment. But the key nugget is that the OTC business itself broke even at the EBITDA level in Q1. This push into consumer-driven products is vital for their long-term growth.
So what does all this mean for their long-term vision? Are those ambitious targets still on the table?
Well, the setbacks have had a cost. Management has said that their goal of hitting 5,000 crores in revenue by FY27 is now delayed by about 18 months.
Makes sense.
And going forward, the plan is to slash CapEx down to just maintenance levels, about 50 to 70 crores a year, to really focus on generating cash. They're also optimizing R&D spend, trying to bring it down from 5.5% of sales to about 4%.
Okay, let's crystallize all this. For our listener who's navigating this complex story, what are the 3 most compelling positives and the 3 biggest risks that could derail this whole thing?
Okay, starting with the positives, the upside.
MMP-driven efficiency. The operational engine is demonstrably fixed. That plan is working. It's delivering real margin recovery. We saw that in the huge Q2 EBITDA jump. 2, regulatory de-risking outside the U.S.
Yeah.
Getting the all clear from the USFDA for their API plant and from the EMA for the Goa sterile plant significantly lowers the supply chain risk.
Okay, and the third positive.
3, strong brand building success. The fast growth and break-even of their Warren OTC business, plus the strong growth in emerging markets, shows their diversification strategy is actually working.
Okay, now the flip side. The negatives, the risk factors.
#1 is still that Goa Plant 2 warning letter. It's the biggest constraint. It's capping their high-margin U.S. revenue, and it's costing them money every quarter.
It's the bottleneck.
It's the bottleneck, too. High debt and finance costs. That big debt load and the 58% jump in finance costs are just a toxic drag on the bottom line. It's what's keeping them in net loss territory.
And number 3.
Sustained profitability is still unproven. Q2 looked great sequentially, but they haven't delivered a sustained consolidated net profit yet. The whole thing is still very sensitive to that U.S. regulatory timeline and the usual seasonality of their domestic business.
So, as we wrap up, what's the single most provocative thought you think we should all be mulling over?
It's easy to get caught up in all the regulatory drama, but consider this. Indoco just got final NDA approval from the USFDA for rivaroxaban. That's a complex, high-value blood thinner generic.
Mm-hmm.
It proves their R&D and product development engine is still very much intact. They are still building a valuable pipeline. So the ultimate question isn't if they can create value. The question is whether their revamped manufacturing footprint can actually execute and service that pipeline efficiently.
That brings a tremendous amount of clarity to the situation. We hope this deep dive into Indoco Remedies has provided significant value for you. If this analysis has helped you gain knowledge quickly and thoroughly, please remember to like, share, and subscribe.
And click that bell icon so you get more deep dives like this delivered directly to you.
Thank you for listening.